Hello, Jarrett Lau here from Profitable Properties Boston. Today's video, I'm going to be talking about something a little bit more advanced, and what that is cost segregation. Now, what is cost segregation? First, it deals with the depreciation of your property. Now, what is depreciation to begin with? Well, a lot of people know depreciation as, say, a car or a sweatshirt that after you buy it and you've taken it off the lot, it's now not worth as much as you bought it for originally. But in real estate, tax depreciation is a fantastic thing. Now let's just use basic math here. $100,000 property gets purchased. Now $100,000 of the property isn't just the building itself that's $100,000. It might be $75,000 of the actual building and then $25,000 on land. But let's just say that the building itself is worth $100,000. That building typically has a flat line depreciation that you can write off over 27 and a half years. If you just divide 100% divided by 27 and a half years, you get roughly 3.63%, right? So 3.63% of that $100,000 is how much? $3,600 or so, right? So $3,600 gets written off, and that's every single year over 27 and a half years. But at the very beginning, when you purchase that property, and probably when you're a little bit younger or just starting out, you're gonna wanna have more increases of deductions to be able to offset against. And what I mean by that is cost segregation for, it depends on your property, but they're about $1,000 to $1,200, maybe $1,500 depending upon your property. A specialized firm will use the IRS tax codes, and this is all legal. You wanna find the right person for this. And more importantly, you wanna make sure that you have a CPA that can apply these type of numbers. What they're gonna do is they're gonna go in, look at your property. If a property is fully depreciated, it's not really gonna be useful for you, or if you bought it a long time ago. It's usually for newer properties. And what they're gonna do is they're gonna look at the tax codes and be able to see what things in your property can be expedited and pushed to a faster, accelerated depreciation schedule. What I mean by that is no longer is your property fully depreciated over 3.63% over 27 and a half years. You might have a huge bump of depreciation and write-offs in the first 5 years, maybe 10 years. I know for myself, I did this and I was able to save tens and thousands of dollars, and it depends on your property. You might be able to save hundreds of thousands of dollars, and what will end up happening is that they're gonna push this depreciation over. You're gonna have less later on, right? But hopefully you're making less later on, you're retired, enjoying your life, and you're able to write it off on your actual expenses as well. And things differ, of course, that if you're an active investor, which we'll talk about in a different video, you might be able to have that offset versus just a passive investor itself. But cost segregation is a huge value. It's something that we do for a lot of our veteran real estate investors who might own multiple properties. But regardless of how long you've been doing it or how many properties you should have, you should be aware of these type of situations, because this is how the rich get richer, and that you take advantage of the tax codes and the ways that the CPAs and everything else can work together to save you money. And at the end of the day, the more money you save, the more money you make. So if you or anyone else you know is looking for a real estate office, property management company that can guide you through these type of tax benefits, along with putting you in touch with the people that can help get it and facilitate it for you, please think of Profitable Properties Boston.